Hello everyone, today is January 21st and this is our third session of the Wyckoff trading course. Thank you for all of your emails and for all of the comments that I've received about the first two classes. You could see some of the comments from students on the left side of the slide. I'm really excited that I hear a lot of excitement from you guys, and that obviously always energizes me, to go on and to think that this is going to be a great cycle. And I see how you guys are communicating with me. It took me a few hours to go through the homeworks. So I've actually was able, today, and usually Monday is my preparation day for the course since the morning. To go through all of the emails, and there were quite a few. So thank you for sending those. Thank you for all of the kind words, by the way, that you sent me, about the course and, the knowledge that we present in this course. So I really appreciate that. I am also was somewhat impressed because the first homework where people send me their labeling kind of gives me an understanding of what the cycle is going to be, and how people are going to be in this course, and so on and so forth. So I was really impressed with the level of understanding of the material. That's number one. Secondly, how you guys are picking up the new knowledge and applying this. Having said this, there are obviously tons of adjustments that we will do, that we will need to do. So, this is not a finished product yet by any means. So there is a lot of work in front of us, but still such a great start. And today specifically with the homework, I want to point your attention to the identification of phase boundaries. Almost in each of the homeworks, we had something to adjust around the boundaries of the phases. And obviously, there's something that I need to give you. So we will definitely go through some of the theoretical material where I will show you how to identify phase C, how to identify the boundaries, between different phases and so on and so forth. And then, we'll go through all the stuff today as well. Next session is January 28th. We are going to continue with the price structure. So these homeworks are fundamental tools for us to start learning about phase analysis. So that's going to be our focus, and we will continue with that on January 28th. All right, as usual, all of our classes are for educational purposes only. Stop your video, read the disclaimer. And then today, actually, let me do one thing, guys, before I'm realizing that actually slightly unprepared. Do you guys see my screen right now? Okay, yeah, you should not be seeing my screen right now. I think, okay. Okay, great. Hold on a second. Okay, awesome. Okay, great. And now we should be back. All right, yes, so we are on the question from Lee. Okay, awesome. Thank you, guys. It's just like one minor technical detail that I had to take care of. So this is a question from the student in this class. Why am I posting this slide here, and why are we discussing this question? I usually email you guys the instructions about the questions as such. If you send me a question that requires a lot of explanation, most likely I will not be able to answer it over the email. But I really, really would like to answer this email in the classroom environment. And there is a specific reason of why I want to do this. If I am spending time answering your email question, and let's say I spent maybe like 20 minutes on that, let's just suppose that this is a big question, then what I'm not doing is I'm not explaining the same concepts to other people in the classroom. So what is the best to do is to have the question that is in line with the content that we are covering right now. So Lee is sending the question that is very close. It's a little bit on the borderline here because we're going to discuss, some supply and demand, but I think it's a really good preview for our second month when we will be diving into the supply and demand concepts. Plus, Lee is taking the chart from our class. This is the chart of Yahoo. So questions like this, sometimes I will subjectively put into the content of the class. We also will have one session, the last session will all be devoted to Q&A. And I know that you have so many questions about the homework right now. We will go through those as well. And usually homework questions, those that definitely need to be addressed during the next class, with the homework review. So we've talked about Yahoo, and we were talking about Yahoo in the context of a change of character. This was the first place where in the trend we saw how the change of character has happened. A much larger reaction to the downside. There is not a lot of supply that's coming in. It's kind of flat, I would even say. But the result to the downside has increased, even though supply has not increased. So what can we conclude? Well, we're still thinking that this could lead to a change of character and therefore a trading range. And then we need to understand what kind of bias we're going to have in that trading range. As I mentioned to you in the previous class, and this is the way how I establish my communication, and kind of like my integrity with you guys. Even here at these two spots, I'm thinking that the bias is still to the upside. I'm not sure if anybody could persuade me otherwise at this point of time. I just don't see any increase in the volume signature, maybe slightly more here, but the result is even less than the first change of character. Less supply on the next reaction, only really 1 day of selling, and then just, inactivity by sellers and more deterioration of the volume and the supply. So we still would be thinking that the bias is up here. And our position is going to be here. I mentioned that probably we would be closing somewhere here on this bar. And this is how we come back into this trading range. So, and then the question is about two spots, or two bars, or rather, two places, number one and number two. So we already see how the price has deteriorated below two levels of the support that were so important. One of them was in the middle of the range and was still, please note, the bias was still to the upside. So now at the failure of this, we have a couple of failures actually. So the first one comes as an upthrust, and there is the first failure. The price comes back into the range. So at this spot, we're always thinking, a sign of strength rally or an upthrust situation. And we'll talk about this more. As the price comes back into the trading range, that becomes a failure, and therefore we start talking about the upthrust. An upthrust could be a function, could be a part of the reaccumulation, that's true, but also an upthrust, could be a part of the distribution. So the next thing that we do after the failure is we want to see where the price will go, what kind of price deterioration we will have, and what kind of character behind this deterioration we're going to see. So we're seeing that the price is committing below local support, and by itself, it's a weakness, at least a short-term weakness for now. And then we see the increase in the effort behind the increase in the supply. So that suggests to us that there is some kind of short-term bearish bias that we should be aware of at this point. The rally, which is going to be an LPSY rally here in the middle of the range, is very weak. It doesn't even come to 1/2 of the move to the downside that we've seen since the upthrust. So again, more weakness, and then a continuation of that weakness, and a slight commitment even below the previous support line. So we are in a sign of weakness type of environment. Supply is increasing, And as we go into those two spots, number 1 and number 2, we are creating the new trading range that already has some bias that we perceive at this point as the downside bias. Why is that? Well, we've seen a change of character. This is the largest reaction to the downside than what we've seen before. And now we are trying to confirm that change of character. How are we confirming that? Well, we need to have a rally, LPSY rally, last point of supply rally, that will fail at some point. At which point would it fail? Well, we want for the distribution this rally to be so weak that it cannot overcome 1/2 of the trading range, or the height of the trading range. And we kind of see it here, right? So the price goes up with enthusiasm to the upside and comes to this value zone right here. And what do we have here? Acceptance of this level or rejection of this level? Supply coming in at the highs of this resistance, or supply is coming in and being absorbed, or supply is not coming in? Well, we definitely see that there are some spots, for instance, like right here, where first of all, after the short-term break of a trend, we see that supply is actually increasing. And this, I wonder if, Lee, you have seen this, spread and this increase in the spread as well, because it's all related to the other two that you've mentioned here. Actually, another one right here. So let's kind of observe what is happening at these spots. The first one, the second one, third one, and then the fourth one. Actually, we could even do this. We could even look at this and this. So one of the things that we notice right away is we want to notice the areas where supply has come and supply has increased, and it's started producing either a stopping action, some kind of reversal action, and then synchronicity with the increasing result to the downside. And that's kind of like a sequence of how supply is going to come in. Supply is not necessarily right away it's going to reverse the whole bias. It's just impossible, because it was the uptrend that we have had. There is a specific sentiment that exists in market participants' minds at this point of time as to what should happen. We should be in the uptrend. We see this from the sentiment we could derive from how the price moves and from the volume signature. Everybody is on board. Nobody is getting out of this position. The first time when we could see a more meaningful getting out of this position is going to be in this area right here. And this is why until then we're still thinking that we might be in the reaccumulation, because the texture for both the price and the volume is such that it dictates that the price most likely is going to continue to the upside. Now, as it continues to the upside, this is where for the first time we're experiencing some increase of the supply. And for the first time, it's not only stopping the price from moving further up, but it actually synchronized with the result to the downside. So this is the first area of significant institutional selling that we see. Now, as we go through the sign of weakness, then we see how supply also comes at the lower level. So we are kind of now in a different value zone. And this value zone, because we're looking at the distribution, is going to be described as the value zone for weak hands. This is just a definition of the Wyckoff trading course that I created, for you guys and for myself. This is how we would define the value zone. So what is happening here? And coming back to this question by Lee, I would like to understand what was actually happening at points number 1 and 2. To understand what's happening at these 2 points, we need to understand what happened prior, and we kind of go into this. So the value zone for weak hands, what does it mean? It means that at this spot right here and at this spot right here, weak hands are buyers. And if they are buyers, what do they see? The weak hands are seeing some kind of value. So that's a very interesting thought. How could they see value at this point of time? The trend up has been broken. The stock went into the consolidation. The stock is at the support level. Wouldn't they feel more fear to come in and to establish this position? It's a very interesting observation about the weak hands, because the weak hands are going to be getting into the trend either very, very late, and they will be profitable. So weak hands getting in, and they will be profitable at this point of time. And then this is going to be the first group of weak hands. The second group of weak hands is going to be somebody who, someone who maybe sold this stock and did not participate. That's number one. Secondly, maybe sold the stock, did not participated, but then got out. And then as the price goes into the consolidation, and especially goes back and produces some kind of move to the downside within the confines of the structure. So this is the structure that we would be looking at the time. The weak hands are going to see some value, and they're going to say, this was a leadership stock, and I didn't really participate, or I didn't participate in this whole trend, but now that we are at the support, this is where I'm going to come in and I'm going to buy. And that's how they see that value at this spot. They're coming in and they're buying, and because they don't have a lot of strength behind it, the rally that is being produced is not that great. And what else is happening, even more importantly, is that into the strength of weak hands at this point, when they see that value, institutions are going to sell into that strength. So, and we are seeing this later on in the selling where supply is increasing, on increased volume signature, and on increased down spread. Look at this spread right here. This is the largest spread in this whole rally. It just tells us that the rally is done, and once the rally is done, you instantly know that this is the high of the rally. And then you start making your assessment and deductions as to what kind of effect was it in the relationship to the whole formation, to the height of this formation. And you see that it's only 1/2 of the range that this rally has traveled, and then it met so much supply, so much selling. Okay, well, then we go back into the same area. Again, weak hands, thinking that this is the new attempt to go up that is going to result in the overcoming of the long-term resistance. And what do we see as we come to the same resistance point? We're seeing how supply is still increasing locally, and not only that, the downward result is increasing as well. So that becomes a reversal again. And you start questioning, we've done this 2 times already. And every time that we've come to this level, what happens? Some institutions are selling at the resistance point. So what is their bias? Their bias is to the downside if they're selling, right? We see that from the increased volume signature. Only, usually big institutions will produce this type of signature. So therefore, we are thinking about confirmation of this bias. And as we go down on the next reaction, we're seeing a sign of weakness. The price commits below. Yes, it comes back, so there is a sprint type of action. But we know that there was selling here, inability to overcome 1/2 of the height of the range, and then a sign of weakness. So this could be just temporary. And we could be just somewhere still in phase B at this point of this whole range. So what do we see next? We see the next attempt, and this is where we're coming in into 1 and 2, those 2 points. And let's see what happens. This is the highest volume signature on this bar, and this is probably just some kind of event. And there is a lot of optimism on this bar. Again, we could see this from the volume signature, and we could see this from the price signature. This is most likely, and this is a weekly chart, this is most likely some kind of earnings and so on and so forth. And the biggest question that actually Lee is asking here, somewhere in the description, he's saying that so much movement to the upside, so much effort, yet what do we do? What is the final result? And to understand the final result, we need to understand the original intent or intention behind this move. If there is so much enthusiasm behind it, the intention was to overcome the previous points of resistance that we were not able to overcome. And then what do we do with all of this enthusiasm that is even more than what we've seen before? We can't even go to the same level. So what looks this something, this move to the upside with so much strength and optimism, looking so bullish at this point, is actually showing us an ability to repeat the same bullish activity that we've seen before on the previous rallies. Is this bullish or bearish? Why didn't it reach resistance? Maybe this is the correct question to ask. Why didn't it reach resistance? What do you guys think? Well, my thought here is that it didn't reach resistance because someone was selling into the strength. And if you think about the tactics of the CO here at this spot, right, at the point of the resistance, they are selling into the strength of weak hands twice already. And now they are selling for the third time at the lower level. So this means automatically that the bias is still being confirmed as the downward bias, and that now the value zone is slightly lower than what we've seen before. So when point number 2 comes, which seems like a very logical diminishing volume signature, so we might be thinking that, okay, supply is diminishing here, which is correct as well. But what's not happening is that we're not going anywhere with all of this increase of what seems to kind of like an amateur eye, a bullish scenario. There is still an attempt to go up, and yet we can't reach even the previous level. So again, we're just confirming the bias to the downside at this point of time, and we are interpreting the increase of the volume signature as still not necessarily a still increase of the supply over average supply. And then we see that supply is diminishing over point number 1, and that tells us a different story. It takes less of the supply to produce more bearish result. And by more bearish result, I mean inability of the price to actually create, even the same, to touch the same resistance or create a higher high. So it's a more bearish result on less supply. What does it tell us? It tells us that we don't need so much supply anymore to push the price down. And at this point of time, demand is so exhausted that all of the next rallies are not going to be that big. And we see it with the next rally, and we're seeing how supply is diminishing even more, and yet result to the downside is increasing even more. So this tells us that there is a poor demand and diminishing supply signature on the background where the price is moving to the downside. And that is ease of movement. On diminishing supply signature, we are able to move the price down. Ease of movement. And that gives us a timing to initiate the position. Why? Well, because again, demand is so poor, we know that demand is not a factor anymore. And even though supply goes down, the price still goes down. So we're just going to capitulate at some point. And we're usually going to capitulate around the point of support. So here's that final institutional capitulation. It doesn't have a lot of supply signature behind it. So that just tells us that most likely we're going to stop soon. We're not going to continue for a long time to the downside. All right, well, Lee, hopefully this is a good explanation for you and for everyone. So really good question. This is not necessarily the question that I was expecting at this point, but I'm really encouraged by the the questions that are coming, and I'm really happy that we're starting with this. By the way, guys, today's class is going to go until 6. We have a lot of material, so I'm kind of already for the next probably 5 sessions. We're going to go up to 6 o'clock, unless I have some kind of appointments arrangements after this. Lots of material, so we're going to cover a lot today. Questions. What about effect in the result if we see accumulation at the right side from 2002, May to September of 2003, only 1 year accumulating, 2003 to 2005, an uptrend, not a powerful effort in an accumulation. Okay. Okay, so let me just, again, to understand this question. So what's the question, Eric? Okay, so this, 2005, and this. Yeah, I'm not sure if I understand the question, Eric. Let's just kind of rephrase it. Let's just think about this. Okay, meanwhile, small time accumulated. You mean this area right here as a cause? Or this as a cause? Okay. So, well, we could definitely apply something like, P and F, try to see what kind of, objective we're going to see here. We could see if this could match this objective as well. At this point of time, we're not talking about the P and F. I'm going to give you some references, but, for those of you who are not familiar, with P and F, please go to our website. There are a couple of things that you could do on the YouTube channel. The YouTube channel has 2 videos right now by Bruce on P and F. Those are basic videos. So go there, and then after that, go to our website, wyckoffanalytics.com, and there on demand products, you could find part 1 and part 2 of the 2 courses that we conducted together with Bruce on the PNF. So I would recommend just that path. Okay, great. Let's move on, and let's just go through the material for today. So today, what are we going to discuss today? This is going to be the major work for us today, to go through the Home Depot homework review. There will be a lot of questions that I will answer. This is the first, well, not the first time, but this is the time where I'm expecting a lot of volunteers. We are going to put on the chart, and we're just going to go through your logic, and then we're going to start adjusting that logic as to how are we viewing the chart, how are we identifying specific events, how are we thinking about labeling, and then how do we think about the tactics, and where would we be thinking about opening the position, and so on and so forth. So this might take even 2 sessions, but we will do this. As we go through the review, I'm going to, after each of the slide, each of the exercise, we're going to have some kind of theoretical material. And the main thing that I want you guys to think about, and this is what I see in your homeworks, is the phase boundaries. That's number one. Secondly, phase C identification, and then everything else, we'll definitely cover everything else. If we have time, we will talk about the distribution. If we don't have time, I'm going to give you that homework on the distribution. I'm going to give you the slides on the distribution. Your homework will be to read those slides through, to understand all of the Wyckoff events in the distribution, to know the characteristics of those events, and then apply them to the homework. And then we're going to do the review, the same review as we've done with with Home Depot. Most likely, maybe not in session number 4, but maybe session number 5. So that's going to be the plan for today. All right, with that, let's start our homework. And I need a volunteer. So say yes, and I'm going to unmute you. And let's see how that's going to go. Okay. Let's go to Rami. Rami, am I pronouncing your name correctly?
Rama is fine.
Rama. Okay, Rama. Almost like Roma. Like my name is Roma, actually.
Right.
My short name, so Rama. That's very close. Okay, great.
Yeah.
All right, so let's look. We have 3 trading ranges. By the way, guys, if you haven't noticed, some of you have not noticed, there is another one that I kind of, wanted you to identify. And by the way, Rama, before we start doing this, let me, guys, show you really quickly something that could be helpful to everyone. So I thought that this idea of having homework slides as a separate file, that was a suggestion by one of you. I really appreciate this because I think it saved a lot of time for a lot of you guys. And I know how difficult it is to do the first homework, especially if you haven't worked with, power charting, power charting, with PowerPoints, with PDFs and so on and so forth. But I was really pleased to see that everybody is just kind of like getting a handle on that. So I want to show you a little bit of what I do with power charting, and it will be really quick. So when you receive a slide from me like this in PowerPoint, why am I saying power charting? In PowerPoint, you have multiple options. Here, for instance, under the first, so you're going to be a Home tab, and then look at all of these small icons right here. So for instance, I could click this icon right here, and I could create any type of text that I want. I could move this text and put it, anywhere I want. So for instance, something like this. I'm looking at the upthrust, and I'm saying this is an upthrust. You can copy that. You could create the new one. You could change the color of it, whatever you guys want to do. Then you have, any type of lines that you want to create. You can copy them, paste them. Here's your trend. What else? Phases. So I like to do this for phases, just to identify where phase is, and then change maybe like the weight, and maybe even change the way how it looks, and just say, okay, here is maybe like phase A somewhere here, right? And then just write it down here, and I could change the size of it, and so on and so forth. So there are quite a few useful things that you could do here with the PowerPoint, and it's actually quite easy once you get a handle on all of those things. So let's just practice. Let's just kind of like go with this, with next homework, and hopefully it will be easier for you guys to use it. All right. Having said this, Rama, let's come back to you, and let's look at trading range number 1.
Okay.
So it's this one right here. So one of the earliest question in labeling that I ask students is, I want them to understand that when you look at the historical chart, historical chart, you know already what the bias of the trading range is. And at this point in the course, this is exactly what I want you to do. I want your minds not to think about the bias first. I want you to understand that we have been in the accumulation and that you need to label accumulation correctly. This is the first task. As we progress to month number 2, that's when I'm going to start closing off the chart and then moving to the right and unfolding the chart and as like swings or bars occurs. And then you will have to analyze the bias and the timing and so on and so forth. But for now, this is what we do. We know that this is an accumulation. So in accumulation, the biggest question that I have on labeling, what catches your eye, Rama, that is so distinctively different than anything else that you could identify right away?
The arrest of the descent of the price downwards, the arrest of the downward movement of the price.
Okay, so what about it?
And the price failing to go below that particular level and rising from that level onwards, defining the level of support.
Okay, well, let's take that thought and let's just kind of develop this. So we were in the downtrend and then we stopped that downtrend at this spot right here. And then after that, we went into the non-consolidating environment. We've talked about this in the last session. So what is this stop in action? How would we call it? How would Wyckoff call this event?
Selling climax.
Okay, selling climax, SC. Are there characteristics of the selling climax that we could identify here to confirm that indeed this was a selling climax?
The range of the price bars, in other words, the spread is wide, and there are multiple such bars, and which essentially indicates to me that the momentum to the downside. And
does it look panicky? Does it look like somebody wants to get rid of the stocks right away?
Absolutely, yeah.
So there is some kind of climactic run that we are observing. Okay, great. We know that, from in hindsight that the price has stopped here. This is the first spot, so usually it's going to be associated with that climactic action, with the selling climax. Okay, if this is a selling climax, then the next rally is going to be what?
Automatic rally.
And then the next low is going to be what?
Would be a secondary test.
And that would conclude which phase?
Phase A.
And the intention behind phase A is what?
The intention is to stop the downward movement and then the beginning of potential trading range.
Excellent. How else would we be interpreting or calling this automatic rally and the subsequent secondary test that is a successful secondary test?
The secondary test and the automatic rally would have volume signatures that would suggest that it's more likely to be an evolving trading range.
But also, yes, absolutely. And here again, we're going from a downtrend environment into a trading range environment. Something should happen right here. Some kind of change. How are we calling that?
That would be the price failing to continue to go upwards. In other words, the automatic rally being limited by a price level which defines the resistance.
Okay, so that's great. That's also another great point. So automatic rally will define an area of the resistance. I'm sorry, the level of the resistance, and then selling climax will define the level of the support. And we would be thinking that the price should consolidate around the mean in this area and be contained. Majority of the price should be contained within these two levels, and it is. So that's great. The question that I'm also asking is that switch between the downtrend to a consolidating environment. When we look at the rally, even the automatic rally itself, and we could see even going into the upthrust right here in potential phase B. Is this the largest rally that we've seen so far? On the way down.
No, on the way down, this is the third such rally and that we have seen so far.
I'm not sure about that. So if this is the high of this move to the downside, right? So we have rally number 1, we have rally number 2. There are quite a few here, so all of this 2, and then look at this rally right here.
Yeah.
Is this the largest rally out of all of the rallies that I've identified here?
Right.
Yes.
I would agree. Yeah.
Yes. So the rally has increased.
Right.
The distance of the rally has increased, and that produced some kind of change.
That's a change of character, yeah.
Yes, yes. So this is where I'm kind of like trying to go with you here. So a change of character. Now we need to confirm it. How do we confirm it? Well, we look at the climactic run, and we are comparing it to the next rally that comes after the change of character rally.
Right. The next decline that takes place.
Yeah, the next decline. And then we see that, again, the distance is diminishing. We're seeing how the spread might be diminishing as well. We're having a higher low right here in this area. So that confirms that change of character. And the change of character is going to be all about, well, something different happens here in comparison to this or this. Every time we either have a very weak rally and then a break to the downside. Weak rally and then a break to the downside. Here we have a much better rally. So something is different. And then we don't have the next break to the downside. Or even in some instances, we might have a small break and then the price will come back into the trading
range.
Yeah. So this is a change of character. This is where everything changes for the downtrend, and we might expect a trading range. And it's always going to be associated on the way in with phase A. Yes. Yeah. Excellent. Okay, so now that we know where phase A is, and by the way, another, for those of you who are more advanced, you might have a question here, and I'm actually very surprised that nobody's asking it right now. Automatic rally and automatic rally. Could it be that we could have, this type of labeling? And I'd say that I would be totally okay with this, right? So, because we have more of this rally and this secondary test that is more of the function of the selling climax itself, and then just a continuation of this rally to the upside. I could label this as an upthrust action right here in phase B, but you could also label this as a much larger automatic rally, and then your secondary test is going to be somewhere here in this area, and this could be your phase A. Now, the biggest question here is, well, what does it mean? I mean, it looks like so discretionary, but the biggest question here is not actually about the labeling. My biggest question to you, all of you guys at this point, is, does it really matter to your trading how you label phase A?
No.
Why?
Because we are just looking at the pattern as it is evolving, the patterns, the nature and the pattern of the rallies and the declines.
Where will you be trading, Rama?
I would be trading at the phase C or D as the trading range, as the price gets out of the trading range and the new trend emerges. That's where I would be trading.
So somewhere here in this area, maybe even more, maybe like somewhere here in this whole area. Why? Because it's always going to be to the right of the trading range where we're going to originate our trades.
Right.
So does it really matter how we labeled phase A? I
No.
see I see a lot of this kind of like this mental, resistance. I have
Yeah.
to label everything correctly. You have to trade everything correctly. You don't have to label everything correctly. I'm going to go even further with this statement. You have to trade correctly. You don't have to analyze everything correctly. And that is counterintuitive because we always think that by making a good analysis that will lead to a good trade. Not necessarily. Sometimes my bad analysis leads me to much better trade than the trade that I've analyzed, a lot. Why is this happening? Well, because, markets are unpredictable, and the only thing that you could really control is just your actions. So if I see some kind of mistake, analytical mistake that I've made, and the market shows to me right away that you are wrong in your analysis, I could mentally make a switch and say, I was wrong. If I was wrong, what is the correct interpretation? Well, it's different. Could I take a trade on that? Yes, I'm still in that zone where I could take a trade on that. So therefore, you could use it like this, like this mental path. Okay, so let's assume that we're gonna go with the original phase A, selling climax, automatic rally, secondary test. Then I already mentioned upthrust action in phase B. So Rama, let me ask you this question. What is
Hmm.
the next point in this trading range that attracts your attention that you could identify right away and you can say, I know what this is? The most obvious thing.
Uh, the most obvious thing is a, a deeper secondary test that occurs um, in November, which is essentially very close to the support level, and
Mhm.
the behavior of the price when it reaches that level.
Okay, so what is it? How would we label it?
I would label
Secondary
that
test?
as yes, ST, yeah,
Okay, great. And there are, by the way, multiple secondary tests.
in
And
phase B. Yeah.
this is also, guys, another thing that I want you to start thinking about. And today I'm going to give you so much material. For those of you who emailed me and you guys said, I watched the video and it was like an eye-opening watching it for the second or third time. And some of you watched multiple times. And I do believe it because going through this, even through this chart, I already gave you probably like a dozens of concepts that you could make a note of. So for those of you who have time, watch the recording again, make the notes, send those notes to me. You're gonna receive so much value out of that exercise. Okay, so what am I talking about here? We have to understand the texture of the large formation, how it forms. We could see that the selling climax is always going to be associated with the secondary test, the retest of that. And then in phase B, Rama has mentioned, this secondary test that goes to the support level. But there are quite a lot of those tests around this area. There are 1, 2, 3, 4, 5 tests, maybe even 6 tests. And you kind of could see from the texture of the price that it's all together. It's not just separate tests. It's the testing um, that takes some time and produces a trading range. So when we look into this, we usually would be thinking that it should belong to one phase. In some instances, we would break this, but in this case, it seems like it should be one test and then one phase. So what phase would it be, all this secondary tests here?
Phase B.
Phase B. Yes, we
Yeah.
still need to experience phase B, and we know that phase B is going to be the largest among 3 phases, A, B, and C. Okay, so if this is phase B, then what is the next most obvious thing that you see in this trading range that you could identify and tell us, I know what this is?
Uh, would be there are 2 points I can identify. One is the upthrust that happens soon after the testing of the support level, and the other one is the the low of the phase C. Those
Okay.
are the two things that stand out.
Okay, so let's deal with phase C first. So why is this phase C?
The price action and the price, again, unlike the other test in phase B, the price gets much closer, and the spread of the bar narrows, and the rally that follows that, for the first time, traverses through the trading range, commits itself above the resistance level,
Mm.
and then stays above that resistance level.
Well, someone has been doing a lot of homework and watching a lot of videos. So Rama, good job. So Rama is giving us a lot of thoughts on how we could identify phase C. I'm going to show you this slide, and in a couple of other slides that we have to cover first, on how could we identify phase C. This is going to be one of the major kind of shortcuts that I'm going to give you guys. So phase C is going to be associated with the number 3 or last test at the level of the support. So where is the first test? Well, naturally, after the climactic action in phase A, that's number 1, and that's at the support level, even though it comes so high, but it's still testing the local stopping action by selling climax. Test number 2, naturally, will happen in phase B. And this test number 2 is just too complex because there is a selling climax, there is a whole formation with a selling climax, automatic rally, secondary test, phase A, phase B, even this phase B upthrust, phase C. So it has its own trading range. So it's just a complex trading range and a complex process of testing that we are observing here. But this is a test number 2. And then phase C always will be a test number 3 at the level of the support. That's very important because test number 4 is going to be at the level of the resistance that was created by phases A and B. We will come back to this later on. We also know that phase C is going to be the lowest low in the uptrend. And because we look at the chart where we know what has happened before, where did uptrend has started? One might argue that, well, we had the start maybe like somewhere here in December of 85, and then we have a higher high and a higher low. One might argue, well, maybe even a low prior to that, November. But for us, what's important is to understand is that there is still a trading range that unfolds. It's a non-trending environment. So therefore, there is no really trend until it hits the low of phase C, and only then we would be seeing some kind of uptrend. Now, we'll have some other different definitions on this subject where we might have even the low in phase A, and that would, establish the whole trend. But we still would be going through some kind of consolidating accumulative actions, prior to that. So the lowest low, when you look at the historical chart, could define phase C for you really easily. That's where the trend starts. We also will talk about a second point of fear in phase C. So that second point of fear either is going to be associated with the increase in the volume signature where weak hands are going to capitulate, and that's going to produce that lower low. Or we could have, like in this instance, a very big distance to the downside, right? So reaction might increase. And that could produce, increased selling behaviors by weak hands, and they will be trying to get out, and there might be some acceleration around the support here. What else? We also said that there are some characteristics for phase C that we need to understand. We definitely know that the reaction should have some kind of bullish signs. And Rama has mentioned those. The downward spread is diminishing relative to what we've seen, let's say, in phase B or on the climactic run in phase A. We could also see that maybe with this diminishing down spread action, the volume is also diminishing. That could be a possibility as well. And kind of a laborious move to the downside instead of very quick, sign of strength type of move to the downside. So that's the big difference. Okay, so let's come back to our labeling. Phase A, phase C. So everything in between is phase B. And we see two instances where the price overcomes the previous high in a very insignificant way. In the first time it tries to commit to the upside. Actually, first time was here in phase B, so up thrust action in phase B. Then the second time it's just an attempt to commit and then the return. And then the third time there is a commitment and then a return back. So all of those instances are going to be up thrusts. There is only one extra definition here that I want you to know. This rally right here, that looks like a rally in phase D. And some of you who are more advanced are probably just thinking, okay, well, why is he not talking about this? Why is this not a sign of strength rally? Why is it not identified as phase D? Well, look at the next reaction that comes after that. It actually negates almost all of the gains that we've seen on this rally. And we've just identified phase C low as the low of this reaction. So therefore, whatever we're observing, all of this moves to the upside are most likely a part of phase B. Now in phase B, we could have upthrust, and some of them are going to be quite significant. The ones that are showing us some bullish activity and that are going to look like a phase D sign of strength could be labeled as upthrust action as a minor sign of strength. Whereas the major sign of strength is still going to come in phase D, right? So we could have a major sign of strength as like this rally, and then a backing up action into the lows of the support that acted before as the resistance. So this could act as a backing up action. So this big rally is going to be a major sign of strength, and then this smaller rally in phase B is going to be an upthrust action as a minor sign of strength. And that's that distinction that I want you guys to give. All right, let me quickly just see what other questions we have. Isn't phase A important for closing of a position, from Philip? Yeah, absolutely. Here at this point, we're going to be facing a lot of trading decisions. I would keep in the position if we are correct on our buys and if we are in this trade. Also, some other decisions, not for those of you who are in this position at this point of time. Let's say somebody is looking at the stock and identifying maybe, some kind of interest in the stock. So in phase A, what kind of trading decision we're going to have at this point? Most likely none, but that's a decision on its own. Not to participate is a decision. Not to be involved, not to get your risk exposure at this point of time is a trading decision. Doing nothing, sitting on your hands, is a trading decision. So those type of decisions are going to be important in phase A. Is there a sign of strength rally after December secondary test? So we've just covered this. Yes, it's a sign of strength rally, but it's a minor sign of strength rally in phase B and not in phase D. Where would you place the trade in phase C? Okay, good question. That comes from Justin. So we're looking at how the price moves to the downside, and we're looking for any points of the reversal, right? So move to the downside, no reversal. Move to the downside, no reversal. Move to the downside, no reversal. Move to the downside, oops, reversal, which would equal our point of entry, and that would be our first point of entry. Our second point of entry could be this bar right here. Our next point of entry will be somewhere in this area where we are experiencing a backing up action. And our fourth point of entry is probably going to be somewhere here on the breakout. This was not the most efficient in this case entry, but still with your stop loss